Well, what a presentation from Evolution Mining and Jake Klein. Goodness me, he knows a lot about this sector and a dividend to shareholders as well. Next up, we have Barry Dawes. He is the executive chairman of Martin Place Securities. And what this man doesn't know about gold isn't worth knowing. So give him a warm virtual welcome from wherever you are in the world. Barry, great to see you. As it says on that first slide, you have the knowledge, the experience, and the vision. What's going on in the gold sector?
Well, we're looking at the next step, and it's going to be pretty exciting. The gold price has been in a nice bull market since 2000. We peaked in 2011. We've come back from that. We rallied up again into 2020, where we saw 2069 achieved. And we've had 12 months, almost to the day, of pullback. And I think that now we're starting to take the next leg up.
Now,
so,
before you go on, just for those that don't know what he meant when he said 2069, that is US dollar gold price, 2069. That was the highest the gold price got. When was that? That was last year, wasn't it, Barry? Or the year before?
Yeah, it was the 7th of August last year.
7th of August last year. So, and it's been pulling back a little bit since then. Sorry, Barry, so I know some people out there will go, what does that mean? So,
yeah. So we had the high, 2089, on the 7th of August last year. So really, we've just had over 12 months of correction and decline, and it culminated with a really big sell-off during the week, where we saw the gold price knocked down by about $150 over a number of trading days. But it's pleasing to see that we've recovered all of that. And I think that we've broken sufficient short-term downtrends to suggest that we're going higher for quite some years from now. So it's always good to look at the long term to see where we started back in 2000, 2001, and we made a low of $246, and obviously people will remember what happened during the GFC. We had gold prices up into 2008, the big sell-off as we went into that whole deflationary period, but with pump priming and QE and everything else you want to call, we saw the gold price rally up to 1921. It peaked in 2011. Now, it was interesting. After that, we had a really savage bear market, which brought down the price of gold back to 1045, but it brought the gold stocks themselves down 80% from their highs in 2011. So it was a very, very savage bear market, but we've turned and we're moving higher. So if we look at the long term, the little pullback we've seen over the last 12 months is pretty small beer, and we're looking for us now with a lot of technical features to follow, that everything is lined up, I think, for gold prices in the next decade to be very strong, and I expect that they will be strong in the second half of this year. All these lines and spaghetti basically are telling me that there's a lot of symmetry in this. We can try and understand some of the driving forces in gold. But keep in mind, the most important thing is that there's 185,000 tons of gold which sits above ground, and that's available at any moment. So it's not as if we're worrying about mine supply or scrap supply or demand. It's really a matter of all those features really are subsumed against this overall position of there's enough gold out there if people ever want it. But so the technical side of gold is very important to understand. So it seems to me, after this 12 months of sell-off, that we're ready to move higher. The medium term looks very good. The long term looks very good. In the short term, we've seen some really interesting technical performances of gold. We're seeing a lot of these uptrends that have been broken. We've seen downtrends that have been generated from the highs. And if we go back to that August high, we've had a downtrend which we broke in May this year, and we thought, gee, here we're moving higher. But as we see with almost every breakout, we come back to test the downtrend line. And in this case, this 2021 downtrend was broken. We've come back, we've picked up some support here, and then with the sell-off we had last week, we've come and back tested on this downtrend. For me, that's very, very important technically. Now, whenever we talk about gold, we've got to be talking about currency, and it's very easy to say that there's disasters that are going on in terms of American politics and financial funding for deficits. Sorry, for infrastructure programs. They're resulting in huge deficits, and the administration there seems to be oblivious of the issues. Now, whilst it's a real problem, if we look at the US dollar and the growth in the Fed's balance sheet and the fiscal expenditures, the infrastructure figures, and all these are really just glorified transfer payments, but they are there to basically depreciate and debauch the currency. But whatever's going in the US is still small compared to what is going on in Europe and what is going on in Japan. If we look at the debt to GDP ratios in Europe and Japan, they're well in excess of what the US numbers are, believe it or not. So we can't get bearish on the US dollar just because of the money that's being pumped out, because the other countries are even worse. The US dollar is still the major currency for international trade, and I can't see anything else coming near it for some time yet. So we should not necessarily get bearish on the US dollar to have a rise in gold price. So the other part that comes in with the currency is the bond market. Now the bond market really is essentially currency with a coupon, with an interest rate coupon. And usually when bonds are rallying and yields are falling, interest rates coming down, the currency will be relatively strong. It's when we start getting interest rates rising and bond prices falling that we start worrying about the currency. Now, we've had this extraordinary bull market, which has gone on for nearly 40 years in T-bonds. And this has continued despite the deficits, despite the increase in the debt. And also in recent times, we've seen inflationary pressures such that the real returns on bonds are negative. So we've got a real problem here in all bonds, not just in the US, where these things are completely overpriced, completely mispriced, and they're very, very risky. We also need to keep in mind.
Sorry to interrupt you there. Why are the T-bonds? I'm just trying to unpack it. It's something that I don't fully understand. Why is that? What's the relationship to gold, and why is it important?
Well, the debt of the sovereign debt of a country is basically shown up in the bond market. The government issues bonds to cover the deficit. So while you've got deficits, you know that the supply of bonds is going to increase. And while we've got new bonds to be sold for new expenditures, we've also got to roll over old bonds. So the demand, the public sector borrowing is just continuing to rise. And we have to say, where is the money coming to buy these bonds? And this is where the Fed comes in to buy them. So it starts printing money. So that the bond market should have been much weaker than it has, in my opinion, in a different cycle. But we are where we are. We've got to understand that there's about $100 trillion of bonds out there, government and total bonds. And from what I can work out, you've got about 70 trillion of those which are being managed by professional managers. So that's an extraordinary amount of money in the hands of a relatively small number of players, and it's in their interest. It's in their interest to keep the prices of bonds high, because they get their management fees are based on the value of the bond, so they don't want to see a risk in that. But we are going to see a day of reckoning, I think, quite soon, when these bonds start to come under pressure. And also, it's my view, it may not be correct, but I think a lot of these fund managers have been the players who have been pushing the gold price down.
Oh.
Now, this is really fascinating, because if we look during the 60s and the 70s, we had professional bond fund managers, but we had much less debt relative to GDP. And so these professional managers were smaller. But as the inflation picked up during the 60s and 70s, what we saw was the fund managers investing up to 10% of their funds into gold stocks and mining stocks to hedge. And hence, this is where hedge funds came from, to hedge their bond portfolios. What we've got at the moment, it seems, is that the people are taking some of that money to hedge by pushing the gold price down.
Oh.
Now, this is just my view of it, because this is the way it comes together for me. But I think that as inflation picks up, they will be forced to come into the gold market and gold stocks and mining stocks to have a hedge against falling bond prices as the yields start to rise. Now, does that make sense? We've got to think in terms of how much capital is tied up in the bond market compared to the gold market, compared to the equity market, and compared to gold stocks. So even $700 billion or 1% of the bond funds would make a big impact on the gold sector. If we had 5%, we're talking $3.5 trillion coming into the resource sector, whether it's gold stocks or gold commodities. And when we have a look at the market and we think about the way all these markets are set up, we've finished what I think is a wave two in Elliott wave terms. And wave two is a period of pessimism, and wave three is optimism. So we've got a lot of pessimism at the moment. We're seeing that the gold price is moving up against bonds. We've seen that gold has basically sold off against commodities, and so the sentiment towards gold is very negative at the moment. But it's really built up power, such that by the time we start looking at the gold stocks are really in the United States, they're the big stocks. They're the ones that matter. They've generally underperformed the Australian stocks, but these are the stocks that we need to follow, because when there's movement in this index, we know that the big money is flowing into the sector. And also, when we look at the Australian sector, most of our big gold stocks are owned by the big international fund managers. So it's not a matter of what the investors in the Australian market are thinking about. It's what these other international players are thinking about in terms of where we go next. And coming along with this sentiment, the numbers.
Misery.
Yeah, we're not down to misery levels, but I think we're very, very close to the bottom and a turn. And I think we're seeing it at the moment. When we look at the individual stocks, when we look at the Philadelphia Gold Index, it certainly seems to me that that's where we're getting at. Now, the other thing is that we've got to be looking at gold versus bonds, gold versus commodities. We've got to be looking at gold in different currencies, and we've got to be looking at how the gold stocks themselves are performing against the S&P 500. It gives us a relative performance, and gold stocks have really underperformed the S&P 500 for quite some years. But I think we're coming to an important turn in that. There are a lot of secular features and cyclical features coming together at the one time. So all these different indicators are telling us that gold stocks are under-owned, gold is under-owned, and so when we combine them and turn them the other way, the market response should be very, very strong. Which brings together all the views that I have about the sector. Now, when we look at the Australian Gold Index, do note compared to the Philadelphia Gold Index that we made new highs in 2020. And we're leading the world. We're leading the world in terms of gold production, in terms of our companies' balance sheets. You talk about Evolution paying its 70th dividend. These sorts of companies are paying dividends. They've got robust earnings. They've got exploration programs that are fully funded and are doing wonderful things in the sector. So we're leading the world. So we've got to look at all these different parts for us to work out where the gold price is going. So stepping back, what we're seeing is the gold price itself has had 12 months of consolidation. It's just at the early stage of a bull market, which I think is going to take it much, much higher. We're seeing the pessimism in gold showing relative performance against bonds, against commodities, and the gold stocks themselves are underperforming the other indices. But that is all changing. And as we look at the ASX Gold Index, this is the one that's leading. Technically, we're in very strong support. We've got a good uptrend. We've got a downtrend which can be broken quite soon. And I think that is going to be quite soon. And this thing can support quite a strong move in the second half of 2021.
That's your presentation, is it, Barry?
Yep.
Fantastic. Well, I've got a lot of questions for you, if that's okay. And I know you're going to be joining us at the Zoom networking later today, because what else are you going to be doing? We're all locked up. Well, I'm not locked up, but you're in Sydney, so you're locked up. Barry, you mentioned inflation and the rate of inflation earlier when you were speaking. I'd like to hear your views, because I speak to people quite a lot, and I've been speaking to them recently, and they really don't believe that inflation is an issue. But I speak to people, smart people like yourself, and they say it's almost like a hidden inflation. It's there. People are not recognizing it, but it will hit them like a freight train. They'll go, oh, goodness me, when did that happen? And that's when you're going to start to see not only a turnaround in the gold stocks, but in certain other real assets, I guess. And I'd love your view on the inflation.
Well, look, the true definition of inflation is increasing the money supply.
Well, we've been doing that.
It's not the CPI, it's increasing the money supply and debasing the currency. Now that's happening all around the world. And this COVID incident has basically meant that governments have spent huge amounts of money at a time when revenues are under pressure. So taxation revenues are under pressure. So they've turned around and they've given money to businesses, to state governments to support people, and it's basically held everything together. But we haven't produced anything to take into account that very strong influx of new funding. So the inflation is coming through. Now, we probably don't think so much about housing prices as inflation, when really it is. It's very strong inflation.
Absolutely.
And that's taking a lot. We've seen motor vehicle prices move up, particularly in the second-hand things, because the supply of spare parts has been limited, and for new cars and also for second-hand vehicles. So there are all those pressures that are coming through. Gas prices, that natural gas prices in Australia are moving up. Electricity prices are still moving up, and you can see the inflation. I'm noticing it in the shops in the rare times you can get out.
Maybe they don't want you to notice, so they lock you. I'm not being a conspiracy theorist. I'm going to just say they'll lock us all up and pretend that it's not really happening, and then you go back to the shops in a year and go, "Whoa, goodness me!"
Yeah, and you look at the United States, where we've got all the data coming through. They've got over 5% CPI,
Yeah,
and that's some of the fastest rise in CPI indices that we've seen out of any recovery. So it's going to be very strong, I think. These inflationary pressures. In some areas, clearly there are slowdowns because of people don't have incomes, or they've got greatly reduced incomes. But for so many people who are able to work from home, they're maintaining their salaries.
yep.
And so they're able to continue to do things. We're not spending any money going overseas. We're not spending too much money on restaurants and so on, or certainly not here in Sydney, and probably in Melbourne. But people in Western Australia are probably having fun. But so there's a lot of build up in people's savings. So the funds out there, and that's also been driving the property market as far as I can see.
But Barry, this is we've got a lot of people on the conference today, from all over the world. I mean, the majority from Australia, including Western Australia. Hello to you, Western Australians that don't like us over there at the moment. But what they're scratching their heads and saying, all right, Barry Dawes, during this particular time where property prices, certainly here in Australia, and I know in the US as well, seem to be going through the roof, the gold price doesn't seem to be going anywhere. And as you said earlier, it actually pulled back a bit and scared a few people last week. What's going to happen towards the end of this week? Who knows? But I guess my question to you from an investor's point of view, what is your sage advice on either equities, physical gold, property? I mean, how do you manage this unprecedented time that we're living through at the moment?
Well, unprecedented is I think absolutely right, Kerry. We don't know because we haven't been there before. There are some things which I think are really important to note. And in the first instance, gold on a relative basis is cheap, as we saw against commodities and against bonds. And in the very short term, it's pulled back from its high last year. So it's cheap relative to that high. And also the sentiment is so bad that, these are the times that you do start buying. So people should have a bit of gold. Do keep in mind that you're not going to be able to use it because an ounce of gold is $2,408 and you can't cut it up. So you can't take a 1 ounce bar around. It's not going to be easy. You could probably do that with some silver, but certainly have the gold there, and whether it's in bullion or in an online account or however you want to do that. But the great thing about gold shares is that they reflect the human spirit. They're run by humans, people who have aspirations, and whether it's a Jake Klein with his particular way of going about things, or Bill Beeman from Northern Star, the way he's gone about things, and now Stuart Tompkins can do it. We look at Newcrest, and the management there has changed that company. So these companies are always evolving, and they're driven by humans, and consequently they always want to grow. So it's not as if you've got static gold production or static operations. So having gold shares, particularly where they're producing gold, earning cash, paying out dividends, good balance sheets, they're growth companies, and you can sit there, and I think you can do really, really nicely out of them. And that should be a reasonable part of your portfolio. We've got lots of second line companies that are coming through, and I have great admiration for the Australian entrepreneurial sector in the resources sector overall. They've got a great track record of finding things, building things, growing things, and it's a most impressive sector, and it's great to feel proud. It's very easy to be proud of being in part of that sector, because it is so professional. So then you've got the explorers, and we've got technology helping us, and you've got good technical assessment of land. We've still got 68% of Australia is undercover. So
is that right? 68%.
68%.
Wow.
So what Chalice has done with Julimar is just fabulous. What De Grey has done with Malina is fabulous. These things are all undercover. Newcrest has now got a program to focus on things that are undercover in Australia and in other parts of the world, and looking at
and sorry to just interrupt you, Barry, again, for people that go, well, what does that mean, undercover? Just explain that to people that don't know. Sorry, it's our jargon, ladies and gentlemen, so don't worry, I stop them when they get too jargony.
That just means that there's no outcrop. And I went up to
in other words, ladies and gentlemen, you can't see the mineralisation. Maybe it's under 1 to 2 metres.
No, you can't see the rocks.
Cover.
You can't see the rocks. Okay, it might be 20 or 30 metres underneath. So the explorers that have put together these things for Hemi, at De Grey, and with Chalice and Julimar, I mean, these are just brilliant discoveries, and reflect the ability of people to see undercover and to get their deductive and inductive reasoning working to see the opportunities of finding stuff.
And I think it's very interesting times now. We're running out of time, Barry. We've got a minute left. So your best advice to our investor audience out there of how to grow and protect their wealth in these unprecedented times? Well,
I'll just focus on gold, a little bit of gold. With your gold stock portfolio, make sure you have a very large proportion in the leaders, and then a smaller proportion in the second or third liners, and keep about 10 to 15% for the speculative things. With that sort of portfolio, you're almost guaranteed to make money. If you put everything in the speculative stuff, you're almost guaranteed to lose money. It's far better to get rich slowly by having that portfolio approach. And I think the big stocks are so cheap that what we're going to see over the next 2 or 3 years is some outstanding performances from these companies. And I've got a target on our gold index that's 250% higher than where it is today.
The gold price.
No, the gold index, the Australian gold index. So that means the big gold stocks are going to move very, very well. So you've got to do really well with those companies. Just sit there and just add to them on dips. Don't trade it, add to the dips, says Barry Dawes from Martin Place Securities. Barry, thank you so much for joining us today at the Virtual Gold Conference. Thank you, Kerry. Thanks for the opportunity.